Now, joining us to put the day's markets into perspective is Makwe Masilela from Makwe Fund Managers. Thank you so much for your time, Makwe. Now, of course, we had that strong bull run that we saw at the end of last year, where we saw weakness basically going in the opposite direction at the beginning of the year, in the days leading up to the rebound that we are seeing today. Was that slow start to the year just a blip in a bull market still?
More or less, and good day to you and to the viewers. To think that, we returned almost 1.8% for the whole of 2023, but up until yesterday, we gave back almost all the gains, that we made in 2023. And we know that the reason that we've managed to have some nice gains is all this issue about the interest rates, the inflation, the bets that when will the guys start decreasing interest rates. So any data that shows the opposite, then it becomes a problem. And today, I think we are thankful to our resources. Also, the rand doing a little bit, weakening a little bit compared to yesterday's close. That is also helping most of our resources stocks. But the key thing continues to be what's going to be happening with the inflation numbers come Thursday in the US, and also the numbers come out of on Friday from the Chinese market. We've seen on Friday last week that the Eurozone inflation went up from 2.4 to 2.9%. So we're starting to be worried that maybe the inflation numbers that have been going down, probably it was just a reading of one or two numbers. Yes, Tokyo's numbers today said something else different, slowing down as well. But inflation will continue to be the theme in the sense that it results on what will be the path when it comes to interest rates going forward. So other markets were down yesterday. They were up yesterday, we were down. Probably we are trying to play a catch-up or so. The question is, will that last for the whole day? I think we have to wait and see.
Yeah. Makwe, could we expect an uptick in U.S. inflation on Thursday, or maybe where it's even more difficult for that inflation to get to that 2% target, especially as we saw last week with the job and wage growth in December in the U.S. Ticking up more than markets had anticipated?
I think so, because I think the markets are running ahead of themselves. It's not going to be that easy to get to that 2%. As we're talking now, we expect anything around 3.2%. 1.2% is quite huge. And not forgetting what is happening with the oil prices, not what is happening also with their currency as well. That's also inflationary. The minute to continue to see the dollar struggling as well. And we tend to undermine the supply chain bottlenecks that gradually gets to be caused by what is happening around the Black Sea. We might not be seeing the results now, but long term, that might have some negative impact. So I don't think I'll be too excited to think that we're heading there. And I think it's just so wrong of us to get excited from one or two numbers. I think we have to have some consistency when it comes to numbers. So the long and short, I don't think it's going to be easy to get to that 2%.
Yeah, and that's the thing. It's a new year, but it seems that some things are still spilling over into the new year. One of those being the Chinese property crisis. And of course, we have seen that affecting the shadow bank Zongzi Enterprise Group, which filed for bankruptcy last week Friday. And I'm wondering, actually, what could be the spillover effects of this?
The Chinese economy will continue to struggle because the property sector in China accounts for almost 30%. And we've seen the guys have been coming with stimulus here and there. And as it is now, we expect them to also start reducing the bank reserve requirements to try to stimulate the economy. But I think the markets were looking more of the usual bazooka when it comes to stimulus coming out of China. So the long and short of this whole thing is that, hey, things won't be okay for that economy as well. And unfortunately, that will have a negative effect when it comes to the growth of other economies, the likes of South Africa included.
Makwe, something that I noticed yesterday, of course, there aren't a lot of company news out on the JSE, but I thought that this was something maybe worth talking about. I've been looking at, who's offloading their stakes in certain companies, and one that stood out for me was Marion Roberts, because yesterday 91 reduced its stake in Marion Roberts, and this is after last month in December the PIC reduced its own stake. But this for me is a bit confusing that these institutions are reducing their stake in Marion Roberts when we did get some good news out in December with the company saying that they have reduced their debt. I know that Marion Roberts has gone through some things, and quite a lot of investors are not even looking at Marion Roberts anymore. Is this one that you maybe still look at, and do you think that it's a concern that these institutions are offloading some of their stakes in the company?
I think they had to, because Marion Roberts is no longer what it used to be. It's all well and good to say you've reduced your debt, but how did you get there? You got there by selling some of the assets, and some of those assets were helping when it comes to your earnings. So going forward, we don't expect you to earn those kind of earnings. So they might as well get out of that. And now it's more of a leaner company. It might not also be meeting some of their requirements given the size when it comes to the market share of that particular company.
All right. Makwe, before we get to your stock pick, we just want to reflect on the counters that have found favor with some of your industry peers.
So my stock pick is ABSA. So if we look at the current price and valuation, we think ABSA is well placed to benefit from the upcoming rate cuts in the country. It's trading at a lower forward PE in comparison to both its international and local peers. We are expecting earnings to grow steadily through 2024 and 2025, with the dividends expected to also increase in the next year. And if we look at the Africa regions, a lot of revenue and profits have been coming from there too, particularly from Ghana and Kenya. So it's a good source of revenue diversity. And we think this is definitely one of the better banks to have in your portfolio at the moment.
Makwe, this is quite interesting, the point that you made on ABSA, on the growth on Africa, because we also do know that even Standard Bank now is trying to really boost its operations in the rest of Africa. Yesterday we got news, just even last year, that Kenny Fihla, the head of CIB there at Standard Bank, will be have more of a role, a group role on that front, while Sim Chabalala, current group CEO, concentrates on the Africa region. So just on the banking front, seeming that there is quite a lot of upside that is expected from those Africa operations. So just your thoughts on ABSA specifically, but also maybe just the broader SA banking sector at this point.
Truth be told, Africa continues to be a last frontier. There's huge potential. But when it comes to banking, we have to be careful. Unlike South Africa, it operates, number one, inflation in those areas as well is at elevated levels, just like back home here. So meaning their interest rates have a potential to stay higher for longer. But more importantly, banks that have been doing great when it comes to Africa are more of fintech more than anything. Hence, even when you even look into our mobile operators, your Vodacoms, your MTNs, they're making good money when it comes to fintech, So it's not more of a brick and mortar kind of a situation. So yes, if they change their model, then yes, they stand a chance and they have to compete with the likes of those mobile operators, let alone other international banks. But yes, ABSA, when it comes to their PE, of 6.5%, is not too demanding, and a good dividend payer of almost 8.4%, not too bad. The question continues to be, going forward, as we said, with interest rates staying higher for longer, the guys unfortunately have to account for more impairments, as more consumers will struggle to repay whatever debt they have to repay.
Yeah, indeed. And we do know also the lagging effects of that, although at some point we might start to see interest rates being cut. But consumers have really, really struggled under this tight monetary policy, and it's going to take quite a while for them to recover. Let's get to your stock pick for today. Makwe, what will it be?
I'll settle for TIPS, which stands for Treasury Inflation Protected Securities. So all it does is that it's linked to the inflation, meaning the value of your money doesn't depreciate. And as you compare that with a 10-year Treasury yield, which is almost 4%, I think is overvalued. That one is sitting at 1.8%. The beauty is the principal amount won't get to be eroded. And as inflation goes up, then also the principal amount continues to go up. So medium to short term, not knowing what's going to be the outlook for inflation, I think that's a better place to be.
All right. Well, thank you so much for your time and for your insights on what is driving the market so far today, Makwe. I really appreciate it. That was Makwe Masilela from Makwe Fund Managers.